like to thank you all for joining today. We've got a really good group of attendees. I'm looking forward to this discussion. Clearly, this is an interesting topic right now. And, although I may sound happy and excited, it's a challenging issue. So we're going to work through some of the difficulties, the bad news that we have to deal with these days, but what we do about it and so forth. With such a good group attending, I definitely welcome questions and comments. So let me know what's on your mind. I'm happy to make this a discussion. So as well as I'm able, I will pause for questions as we go through. Let me start by saying this is a joint presentation between Model Risk Managers International Association, MRMIA, and Deep Future Analytics. I have the privilege of being president of MRMIA and also CEO of Deep Future Analytics, so I try to bring these communities together. MRMIA, just a couple of words quickly. It was launched in 2019 and has grown quite well. We've had two very effective conferences in the last 2 years, covering a wide range of topics. If you join MRMIA by just going to the website, mrmia.org, you'll have access to all the previous recordings. And I know some organizations are using that for training purposes. So there are dozens of recorded sessions there from our conferences and other webinars that we've had, along with a lot of a long interview series that we've conducted. So there's a lot of great content there, and we'll keep going with additional content in the future. So for today, I'll be discussing capturing adverse selection, quantifying shifts in the credit cycle, distinct from the economic cycle. So what do I mean by adverse selection? Well, the simple definition is that we did not get the credit quality that we expected when the loans were booked. And when we talk about credit quality, usually we're talking about something like delinquency or probability of default as our measure. Now, there can be many reasons for this. So when I say not what we expected, usually we're looking at bureau score, LTV, that kind of information. And adverse selection is best described as something that is driving a change in the credit quality of the loans that is not explainable by the usual factors that we look at. So sometimes this can be competitive pressures. If your pricing is out of market compared to your competitors, either above or below, you may drive a different pool of borrowers than one would normally expect. So the usual situation might be that if rates were to fall in the near future and you don't drop your rates along with the market, then those who would accept higher rates from your institution would be the ones who couldn't get lower rates somewhere else. So that's a kind of a microeconomic adverse selection. Alternatively, we could look at macroeconomic adverse selection, which is that in certain economic conditions, it will drive the lower risk borrowers out of the market. It shifts the borrowing pool. So this will be the primary topic that I'll go through today. I'll put a lot more detail behind that sentence I just gave you. There are other possible reasons for adverse selection. One could be changes in underwriting or an underwriting failure that allows through riskier loans than you would normally expect. And even in certain situations, we might look at score inflation. During the pandemic, when everyone received a check in the mail, regardless of employment status or certainly regardless of their credit risk status, then you can get a healing financially of many of those borrowers, which would then lead to a better credit bureau score than one might expect to be true down the road when they revert to normal habits. So that score inflation may have had the effect of making everybody look as if they were lower risk than they would in the future. So um, interesting items here. The one that I have data for, as I said, is the macroeconomic aspect. So I'll focus on that. So when we look at the economic cycle and the credit cycle, I tend to put this into the context of an analytics cycle. When do we need to look at different aspects? So, you know, when we're in calm economic times, if you think back to the period really between 2012 and 2018, there was some variation, but in the end, not a lot happened through there. And so we might consider that the long stretch of expansion where with losses being generally flat, most any model could predict through there, and you wouldn't see strong variation in adverse selection. But as conditions change, right now we're at a point where we think there could be a recession next year. In fact, the latest stats say that the consensus economic forecast, about 40% of economists are predicting a recession next year. That's not 50%. That may sound low, but it's actually the highest percentage of economists to predict a recession ever in at least the last 20 or 30 years of surveying economists on this. So more so than any prior recession, they expect a recession next year. That's quite telling. Now, if there's a recession, that means that all the loans on in your portfolio today may have higher losses next year due to economic conditions. That's different from looking at conditions today and asking who wants a loan. And so when we talk about adverse selection, we're really talking about the economic conditions at the time a loan was taken out and what that says about the borrowers and possible shifts in the borrowing pool. So I've got a big arrow here for where we are in the cycle, which is that stress testing for next year is becoming more important. Credit risk modeling right now is very important, given what may be happening in credit quality. And of course, there are other things we have to do on a regular basis, but just some things to keep in mind. So the first way to find adverse selection is just make a vintage graph. And we've been doing things like this in the lending industry for at least the 30 years that I've been aware. The idea would be to look at performance for a vintage pool. A vintage, just by definition, vintage means the month or quarter or year of origination. Take that pool and then look at their performance from that performance date. So performance could be the number of accounts delinquent or the number of charge-offs. You can look at this as month by month, kind of instantaneous values, or you can look at it cumulatively. Many people would make a cumulative vintage graph on charge-off and ask, how are my recent vintages performing compared to prior vintages? What we want to be aware of is situations where the early delinquency or charge-off on those new vintages is significantly different from what we're seeing on previous vintages. So in the graph here, I'm actually showing this dark black line coming in at higher risk than previous vintages, and perhaps the green line as well. This is what it means to do vintage tracking. It doesn't tell you why, and it doesn't tell you whether you expected this or not. But basically, anytime you see the initial performance being worse than previous vintages, you want to look into that. So this is always the starting point for generating intuition about what might be changing in your portfolio. And then you step back and start asking why. If all of my vintages at the latest observation points were showing increased losses or increased delinquency, then that would lead me to think it was the economy. If instead I see relatively flat or steady performance, but the newer ones rising fast, that leads me to worry about what's happening in my credit quality. And of course, the first thing I would do is look at underwriting, look at policies, but then I'm going to have to start asking about possible adverse selection. So the process for this, um, really adverse selection is just something your model didn't anticipate. So in principle, you can do this with any model. In practice, you need a way of measuring this relative to the age of the account. So if you have a credit score that predicts losses over a 2-year period, that's nice, but you can't wait 2 years to see if performance agreed with that score. You're going to need something that takes vintage effects into account. Basically, that you can do a comparison at any age of the performance of these loans in order to be able to measure this. So the way I do that is always with age period cohort models, survival models, a hazard function. Any of these things would give you that effect. An APC model will let you normalize for life cycle and economic effects. And then, of course, to look at that either segmented, so I can ask, within a certain bureau score band, bureau LTV, whatever dimensions I'm looking at, do I see variation within that band? Or I can go straight to an account level score. So a score that's combined with the vintage analysis, the way you would in a Cox PH model or the methods that we use here. And then once you have a model that can quantify those effects, getting to adverse selection is really to look at a vintage level residual. What's the credit risk I'm seeing that's not explainable by these other factors? So just to visualize this a little bit more, if I were to use an APC model as a first step, I would need at least vintage aggregate performance data on something like PD, charge-off rate, delinquency rate, run that through an age period cohort decomposition in order to extract life cycle, credit quality, and environment. Right away, if it's a segmented analysis, I can look at that credit quality function and ask, do I see variation there? Of course, you almost always will. And the question is going to be why? What's the cause of that variation? And so this is a recent analysis of credit card data. And here on the left, you see a graph of many vintages. And I think here I might be graphing it by quarterly vintage. The more granular you can get, the better your results will be as far as knowing which vintage is causing problems. The graph at the top, these are just the smoothed life cycles. So what is my expected delinquency or charge-off performance versus the age of the account? This is not cumulative, this is instantaneous. So it's saying at a certain point of time for the accounts that are active on the previous month, how many of those would charge off this month? And you can see there's a difference in the expected functional shape here for the different credit score bands. And then if I look at the bottom graph, this is the environment. This is the risk through time where up is more. This is in units of log odds of default or charge off. So it's a log odds scale. And it's showing that there was a period back around the 2009 recession of higher risk. Then as the environment improved over time, we have lower risk. There's some variation in here, which is due to industry shifts. You can see a period of low risk in the pandemic where there's significantly lower economic impacts, and then a jump up in some of these portfolios as forbearance programs wore off, et cetera. So This is interesting, but for our purposes today, this is just what we're cleaning out of the signal. We're normalizing for this effect. So we don't want to say it's a low risk vintage just because it's living through the pandemic when there were forbearance programs. We don't want to say it's a high risk vintage just because those programs went away. We want to look at the residual risk. So the graph on the right is looking at the vintage function. So this is the scaling coefficient by vintage, looking at how much risk there is after normalizing for life cycle and environment. Right away, you can see in the right-hand part of that graph, starting around 2021, a dramatic increase in the risk. Now we've segmented already by FICO band. So this is saying at least that the credit quality within each of those bands has been deteriorating. This is a credit card result, and I'll show you more of this later. But you know, there's some interesting variation in here. You'll see some periods where in the past there were periods of higher risk. Back around 2006 and 7, we went through a higher risk period. There was some higher risk after 2015, but something definitely has happened more recently. Now, if you have account level data, you can take this another level. So instead of just segmenting by FICO score, if I had debt to income or other performance indicators, I could use those to adjust as well. Now, I'm just looking at origination information when I talk about this, because of course, delinquency will rise, other things, just because it's higher credit risk. I don't want to dilute my signal by looking at behavioral data that happened after the loan was originated. I want to answer the question, were these loans riskier from the point of origination? And so if I'm going to do account level modeling, I can add this origination information and set up essentially a panel model where my life cycle and environment are fixed inputs to a panel regression model, and then I have performance data for each of the accounts. And you know, there are published ways to do that. So overall, high level, the idea is that you look at vintage performance data. We are subtracting off the aggregate account level forecast that you would get from something like a vintage model, life cycle and environment, to get to the residual by vintage, this adverse selection effect. Now, we've seen this before. I had the privilege of working with Jose Canal Cerda at the Philadelphia Federal Reserve to analyze the performance of mortgages through the 2009 mortgage crisis. And this was done after that crisis. We did most of the work around 2012, 2013, taking all of the performance data from that period, data that the Federal Reserve had access to. We set up the kind of model I just described, an account level model that had life cycle, environment, and scoring factors. And specifically, we wanted to account for everything that lenders could have known at that time based on what was in their data. Now, this doesn't talk about what they could have known from their own internal underwriting policies. And there were some interesting things that happened there. But the things that were in the data. So we looked at, you know, loan purpose. Was it a jumbo loan? Debt to income, of course, FICO score, loan to value, all these different factors, as well as the life cycle and the economic conditions. And when we built that model, cleaned all those things away, we still had this residual that you could see where there were very good loan periods back around 2003. There were much higher risk periods in 2007 and 8. And this variation after subtracting all that other stuff said that there was still something happening in '05, '06, '07 that was driving significantly higher credit risk. And then in 2009, you see a sudden drop as the loan quality got much better. Now, this was the output of that one specific study. Separately, we were able to uh, concatenate previous credit cycle analyses as well. And what you could see is that we had at least three clear peaks in credit risk going back through the prior 20 years. Each of those happened just before a recession. And in fact, if you looked more closely, they were very clearly tied to changes in interest rates and changes in house prices. And in fact, those things correlated also to changes in loan demand. So as an early warning indicator, one of the things I've always tracked ever since we did this study was the senior loan officer opinion survey. How is demand changing through time? And in short, if demand decreases, it's usually decreasing because it's getting more expensive to buy the item that you're looking at, and more expensive because either the cost of the property is going up or the cost of borrowing is going up as interest rates rise. In fact, there was a third effect that if house prices are falling, your financially savvy borrowers also don't want to buy in that environment. What they really want is a period of slow, steady increase in value. That's what feels like a safe investment, because buying something like a home is a significant investment. So really the way to think about adverse selection is that you have a certain pool of borrowers. That pool is not static through time. And in fact, what happens is that the distribution of borrowers shifts based on economic conditions, and it shifts in a way that you lose your most conservative borrowers. And the best intuitive example I've found of this is not actually related to economics, but the first time I saw this, I was analyzing auto loans for a portfolio in Minnesota. And if you looked at the credit quality that they were getting in a specific FICO band, it was strongly seasonal. And when I say strongly, like a factor of 2 in credit quality. So why would adverse selection have seasonality in it? It was an interesting question. And what we saw is that, well, the best loans were coming in December, the worst loans are coming in June. And the main thing you'll notice, of course, thinking about Minneapolis, is that someone who's willing to stand on a frozen car lot and argue over pricing in December because they know they're going to get the best deal with end of year tax burden for the dealers, that person is not the same person who goes to buy a car in June because the cars are washed and the balloons are flying. Those are different buyers. And in fact, what we find is that the first group we think of as value shoppers. Value shoppers are in the market when there is a value to be had, basically when they've got a coupon, when they've got a discount. The impulse buyers, the people who buy because the cars are shiny. They buy because they need it now and they're not thinking through the financial implications. Impulse buyers are always there. So in your distribution of borrowers at a certain score value, LTV, etc., you have this blend of personality types, the value shopper and the impulse buyer. From the data alone, you can't tell which is which. But in certain economic conditions, we know that we lose the value shoppers and we're left with the others. So this is the basic philosophy of adverse selection. For those who've heard me explain this before, I'm sorry to repeat all that, but I wanted to give that background before we look at some of the results that we're seeing today. Now, to do that, Deep Future Analytics has a shared data pool, which is run for our clients. It has about 2.5 trillion in assets covering all loan types, and it goes back to about 2001. So we can run this analysis on all these different pools. We're doing this using our multi-horizon survival models. They start with a vintage model, like an APC type of model. To be specific, in fact, we're using a Bayesian APC approach, and you'll find that described in the literature. And then we add to that an account level panel modeling that brings in all of the available scoring factors. Those two things together is what we call this multi-horizon survival model. And then we look at the vintage residual to that model. And that's what I'll show you some of. So first thing here, credit card. I showed you this a moment ago. On the left, you can see this segmented by score band. And credit card is not the first one we would think of as being sensitive to interest rates or adverse selection in general. And in fact, if I look back at the 2009 recession, the product that was most strongly impacted was mortgage. And the next most impacted would be auto. It was only about half as much the magnitude as in mortgage. And if I looked at credit card, it was about half as much again. So in 2009, if I were to see a 50% increase in risk in 05, 06, 07 for credit card, I'd get about a 2x increase in auto and about a 4x increase in mortgage. Well, in the most recent period, we've seen the most rapid increase in adverse selection, residual credit risk in credit card as we have in any of the prior 2 decades, more so than what we saw. You can see a little bit of a bump in here around 05, 6, 7. It's significantly higher than that, even considering the confidence intervals. That's the shaded band that I've got here. And it's strongest in the highest score segment. Now, the reason for that would seem to be that we have the most value shoppers in that segment, or to say it differently, we have the most people with options, that they have alternate channels for how they want to borrow. And so if the opportunity doesn't seem to be to their liking, they won't take a credit card. So another way to say this is that in the last 2 years, especially the last 18 months, the value shoppers haven't wanted new credit cards. And we also looked at this by balance transfer or not balance transfer. And again, those without taking a balance transfer are the ones showing the strongest effect, the ones with the most flexibility, the most other options. So again, more like your financially conservative borrowers. Now let's look at auto. So I'm kind of going in the other direction from if credit card was supposed to be the least risky or the least vulnerable, auto loans here, we see that we're getting a dramatic impact from adverse selection as well. I would say this signal is a bit cleaner. We've got a lot of auto loan data. You can see clearly that back in 06, 07, 08, we had a period of much higher auto loan risk. The scale here is again log odds of charge off. Things improved in auto and they were in a pretty good state for almost a decade. We had some very low risk loans back in 2019, 2020, and then the risk started to rise. Now, what's interesting, I talk about interest rates increasing, but in the second quarter of 2021, interest rates were not rising that much, but the cost of the car was. We had the chip shortage that caused a production shortage in autos and therefore a dramatic increase in used car prices. And so if you compare this to increases in used car prices, you can see a run up occurring. And most recently, 2021 and into 2022, This is persisting. Now, in the most recent vintages, we don't have a lot of data yet, so the confidence interval is quite wide. I can't be certain of the exact level, but of course I can tell that it's higher than it was in the previous years. So based on this, we definitely think that the credit risk is higher in these most recent years. And based on the way interest rates are changing right now, it's probably continuing to be high through now and the rest of 2022. Even though this looks like it has come down a little bit in the most recent period, that could just be uncertainty in the estimation. So we'll have to wait and see how this plays out. Um, Now, if I look forward and say there might be a recession next year, the Fed is already saying that it probably won't raise rates as fast as it has previously in December. So in December, maybe there'll be a half-point increase instead of three-quarter point. Um, a recession next year, given historic patterns, would usually mean the Fed would lower rates. And in fact, a lot of economists are saying that rates may come down by the end of next year. That will help when we think about adverse selection, because what really matters is change over a period of time. And so if I'm looking at change in the cost of buying a car over a 2-year period, and I should say that the cost of the vehicles is also coming down right now, then by the end of next year, conditions may be more favorable for some of those value shoppers. You may see some of them return. I wouldn't expect the best periods like back in 2019 or 2010, but we may be getting back to a more normal period by the end of next year. We'll see if we get back to 2014, 2015 levels, for example. So this is the pattern that we're watching closely. Now, credit card and auto, we look at these because we see the effect quickly. Um, Mortgage, I'm actually more worried about because the borrowers should be even more sensitive to the cost of a home, to the cost of borrowing. And in fact, compared to 2020, which was the best period, we have seen the adverse selection, the credit risk, residual credit risk in mortgage rise dramatically, but still not back to 2006 or 7 levels. And yet the rate of increase in both homes and interest rates are as much as we've ever seen, within the data range that we have. So once we start to see the delinquency and default from the recent vintages, because the life cycle usually peaks in the third year, it's going to take time to see that data come in. I expect we will see that the risk in these recent vintages is actually quite high. Now, there has been news. There was an article by ABA highlighting that early delinquency on recent vintages is higher than it has been in recent years, and there is some concern about the cause of that. So that's consistent with the increase we're seeing, but I don't think we've seen it all yet. You'll notice this is the subprime pool that we're looking at, and that's because they're the ones who have the delinquency and loss happening earliest in their life cycles. So they're the easiest ones to measure early. Prime and super prime mortgage, that develops more slowly, so it'll take time. So this may not be appearing in your data today for mortgage, but I would be worried that it will as those loans mature. So it's definitely something to keep an eye on. Now, before I go further, I want to encourage people, if you have a question, you can take yourself off mute and ask a question, or you can give it to me in chat. But definitely want to hear if you have questions or thoughts about what you're seeing. You can, raise your hand or interrupt me when I take a breath. I'm happy to answer. Now, I get asked a lot, okay, what do we do about this? There are two parts to that. First of all, I have to say the first question I always get asked, well, who are these? If we know that we have risky borrowers in the pool, how do I find them? And I have to say that's the real challenge here because they don't look different based on bureau data. I can have two people, one who is conservative and the other is a risk taker. Um, but historically, the risk taker may have gotten lucky. The conservative person may have been unlucky. They might both have the same FICO score, but their propensity to pay, their likelihood of paying in the future can be quite different. So there's nothing in bureau data that's going to tell me about personality. Now, maybe you have a machine learning model with some alternate data sources where you can measure personality. That sounds great. You might run into regulatory challenges with that, which is why most people don't have that, because we have to make sure we avoid bias and other things. So it's hard to use that kind of data to measure personality without getting sideways on some of these other bias measures. But ultimately, it's very difficult to know at the point of origination which is which, other than to look in aggregate and say, why would you want a loan now? And do. So if you can't tell who they are specifically, you can still get more conservative with your origination. So what I hear people doing today are looking more closely at the underwriting process, trying to be more careful. Um, it's difficult just to shut off lending. Some people do, and in fact, we saw that happen back in 2009. People who just said, we're not doing any more subprime auto. We're not doing any more subprime mortgage. Um, that can work, but it's a bit drastic. And in fact, it usually happens too late because if you don't really see those losses until next year, well, in a recession with falling interest rates, you're likely to get better quality loans. And so that's a little late to shut off lending. You've got a different problem at that point. So today, no recession yet, but maybe riskier loans, you have to look at underwriting and ask what are the knobs you can turn to more carefully screen your applicants. Now, I hear people doing things like they have a dealer network for auto loan origination, and they've started doing spot checks on those applications to make sure that the income reported by the dealer is a fair representation of the borrower's income. So income verification, that sort of thing. And they find some dealers fudge more than others and have to be brought back in line. There are a range of things you might do. You also might look at, if you know that the loans you're booking today are riskier than average and expect that there could be a recession next year, at least plan for that recession. So are there certain pools of borrowers who are more recession proof than others? So, the classic examples being government employees, teachers, healthcare workers, people like that may be more recession proof than others. But that depends on your product, your customer base, your borrower base, to decide what you might want to do to be more conservative. Um, Certainly, there's the opportunity to pass this information on to collections. Um, your collections group needs to be informed that certain pools may be higher risk than other pools, that pay careful attention to early delinquency in recent vintages, um, because that may be a bigger indicator than usual of risk. And in general, increase the collection score risks for recent vintages. And in fact, the adverse selection factor should also be given back to the origination team. That you will have noticed in my graphs that adverse selection trends with time because it's related to conditions in the economy, and the economy trends with time. This is not just random noise. So that trending, if you ask, I see it today, I see it in originations a year ago, would I still have it now? pay attention to what's happening in interest rates and house prices and auto prices. But in general, yes, if you're seeing adverse selection from loans originated 9 months ago, 6 months ago, I would assume that effect is still there. So if you can quantify this as an adjustment to the log odds of default, give that to your originations team. They can use that as an adjustment to their origination scorecard or possibly to pricing. But there is a catch. If you wanted to increase price to account for this increased risk, well, rising cost of borrowing is part of what's creating the risk. So there's a spiral that you can get into there. So you may not be able to increase price. You may not want to pull out of the market, but you can still set your expectations better in terms of what is your potential profitability, what is your potential loss from those pools. And perhaps even if you don't adjust your pricing, you might want to adjust credit limits or other aspects of the product offering. So in terms of data needs, if you want to estimate this yourself, plan on needing a certain block of data, something like 4 years of history, so that you can estimate life cycles. You can do a segmented or an account level analysis to adjust for what you know, and looking at things like delinquency or default or charge off as your target variable, you'll need that kind of data. So that's what we're looking at for performance data, kind of as a minimal starting condition. And that's the prepared content that I have today. And feel free to reach out to me if you have any questions. So let me stop sharing and see if I can go back and find some of the chat. Okay, here we go. So a question here, how do you account for market manipulation like LIBOR or CARES Act misconduct, some of these things? Well, any of those variations are going to show up historically as being part of the adverse selection measure. It's not telling me that it's only this story that I put to it. In fact, adverse makes it sound like it's always bad. We saw there periods of what you might call positive selection, better than average quality. Certainly, loans originated in 2020, there was a strong positive selection because people had money, and there was the ability to book better loans than average during that period. So when you get this signal, it always looks like this noisy random walk of information, and then you have to be a data scientist, look at that graph and say, what is causing this? What can I attribute to my own actions, or what can I attribute to the overall environment? Now, one thing that happens that you can do, and I forgot to mention, is that of course, a group like ourselves, where we have a shared data pool and we're measuring this on our shared pool, graphs like what I just showed, you can, we would work with clients to compare that to a measure that's based just on only your internal data. So if you compare internal adverse selection to industry adverse selection, then you can immediately answer this question of, is it me or is it everyone? Am I seeing these things because I had an underwriting failure, because something happened in my market or with my borrower base, or is it everybody because it's interest rates and house prices? So I think that's the usual benchmarking that you like to do, no matter what the question is. Benchmarking is important here too, if you can do that. And then another question, other than this independent analysis, does this analysis detect some risk correlation among mortgage versus auto versus credit card debt? So is there correlation between products? Definitely, because they're all responding to the economy. Do some of these products act as leading risk indicators to others? I would say yes. That we saw this first in things like personal loans and auto loans because their losses can come earliest. And I would say historically, we see the most adverse selection in the highest FICO score bands, um, but the losses tend to come quickest in the low FICO score bands. So even though it's a weaker signal, low scoring accounts tend to provide a bit of an early warning indicator to what might be happening broadly in the portfolio. And question here, compared to traditional analysis, how much of this current analysis can be, I'll read this two different ways, how much of this can incorporate machine learning. I get asked, can machine learning models solve this problem? I have a definitive answer to that, no, because machine learning models are based on data, and in many cases, the same data you're using with a traditional model. The only exception to that would be the one I gave before, if the machine learning model is looking at data that might give an indication of personality. But again, we don't see that very often. What we mostly see machine learning models being used for is to find nonlinear structure in the kind of data that we've already got regulatory trust in, a lot of financial data. So machine learning itself, nonlinear modeling itself, isn't going to pick up on this. This is a residual based on what is not knowable from the underlying data. Hmm. There's one other thing you need to think about with machine learning models also is that I have to say all the machine learning models I've seen used in credit scoring are actually used in a traditional way of saying, here's an outcome period, 1 year, 2 year, whatever it is, build your ML model on that time period and then run it. In order to measure adverse selection quickly, we want that vintage aspect. And so I don't want to wait for that outcome period. And that means you need to use your machine learning model in a different way. You need to combine it with vintage modeling. Now, I did give a talk as part of to the MRMIA community around this time last year on how to combine vintage modeling with machine learning, and that is recorded. It's in our library. So if you're an MRMIA member, you have access to that. But in general, if you want to know how to combine machine learning with vintage modeling, so you can do this kind of monthly analysis, cash flow analysis with machine learning, let me know. I can go through that. There is a way to do that, but I'd have to say it's not what I typically see people doing with machine learning. Okay, so those are the questions I've had so far. I guess one other question here, will the presentation be available? Yes, we're recording this, and we'll definitely be able to share that. So another question, when a mortgage borrower enters bankruptcy, their FICO score drops for a number of years. Your thoughts on the implications of that for modeling, because it'll have impacts, and that's irrespective of how the borrower proceeds in default. So this question of how bankruptcy affects FICO score and what the impacts might be, I guess in the context of adverse selection, um, I haven't considered this question before. I'm not sure that it will affect our overall aggregate measure of adverse selection. Some of the leading causes of bankruptcy are medical bills, which, hopefully 8 years later, they're not recurrent, or multiple years later, um, that kind of thing would be resolved. So that sort of bankruptcy is not really a risk indicator, but I would view that as kind of, regardless of the cause, there's kind of an underlying layer of bankruptcy that happens unless it's bankruptcy specifically due to a lost job in a recession. So to me, that's part of the normal process. Um, if I'm looking in aggregate across a portfolio, I'm not sure that I would expect to see that as a driver of adverse selection specifically. Um, it bears more thought. So I'm pausing just to see if there are any more questions. We've had some good ones here. And of course, in my remarks, I've been answering questions that are most often asked of me anyway. Um, I would say that going forward, whether you're looking at interest rates or looking at loan demand, or basically if you want this to anticipate when adverse selection might be happening, I would encourage you always to look at interest rates, the cost of the thing being purchased, and the senior loan officer opinion survey on loan demand. And so another question I regularly get asked is, do we see this in commercial? Because I'm only showing results for consumer. Well, on the commercial side, the emergence period for losses is much more protracted. I think it's fair to ask, my best way to develop an intuition for this adverse selection issue is to say, why would you want to borrow now? Why do you want this loan today? It's the old loan officer question. And if you ask about commercial lending, in this environment, why would that borrower want to loan today? I think there's certain industries where it makes perfect sense that somebody might be in a position to expand. But if you look at the tech industry, and there are a number of industries where people are talking about layoffs, if somebody's looking to borrow money in an industry which is struggling, that suggests risk. Um, that is not the same as somebody borrowing money during an expansion opportunity. Their financials may not show that. They might have a good story, but still, if rates are rising, I think you need to look more by industry. But anytime rates are rising, you've got to uh, be cautious about what might be there. So in my commercial portfolio, I would try to segment by industry, and then you won't be able to get a good clean signal on this for some time. So you're going to have to address this more intuitively today, but try to use that judgment in how you do underwriting for commercial lending. Okay. I don't see any more questions coming in. I appreciate the questions we've had and the excellent attendance. So thank you all for joining today. Oh, I see one more raised hand. Um, okay, Russell, I don't know if you want to chat something to us, but I'll tell you what, I'll go ahead and end our session today, and thank you all for coming. And I'll stay online a bit longer if anybody else has further thoughts. So thank you. Take care.